The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. As you heard, 877-927-6648 is the number to call. You just heard Steve Rhodes for 2 hours give a fabulous analysis of the markets, different stocks, different indexes, using his Rhodes proprietary Rhodes index. And we here at TFNN, we're all about education, and it's really important. And we all have our various techniques that we use. You're looking here at a screen. If you're looking at Tiger TV, I'm showing the E-mini, the September E-mini, ESU14. That's how I get it in my program. And it's trading down 1350 at 1957.50. And I can show you different techniques right here that I use. Actually, this has got a plethora of techniques in the daily. The 120-minute chart, I always start off with this, showing this series here, the daily and the 120. And normally I would be looking at charts like this with the daily on the left. In the middle, I've got the weekly. On the right, I've got the monthly chart. Now, what you'll be able to see, and welcome to those who are using eSignal, what you're going to see is something that's a little bit unusual in looking at chart formation, something I developed back in the 70s, refined it a lot in the 80s. Actually, I must say it was probably more in the 80s that I developed this. I noticed that in the charts that I used to look at, and I used to get these books and chart patterns, on the charts themselves, and then I would look at the chart patterns involved. What I would do is I would look at the chart and I would say, hey, well, at a certain point I found that counting each successively higher peak, and I used to hand chart, so that on engineer paper, those little tiny squares, I'd join the squares, each square was a point, I believe it was, yep. And so if you go back to the 1930s, where I went back and charted every single daily chart of the Dow from 1924, I think it was, 23. And I used to take a little pencil, take my pencil and draw the line. Back in 1987, when we got the crash of 1987, I joined pieces of paper, engineering paper together to go back. And I had about I've got somewhere over here, about 3 or 4 feet high charts, because it was point to point going back to the 1920s. Obviously, when you get into the 2700s, there's something different. Today, we're in the 17,000s. Well, today we went a little bit under that. And thank goodness for the computer, because we were able to generate these charts in a split second, as many charts as you want, and do whatever you want with them. And what I've done here is you're looking at a chart that basically has a large arch formation. And this is one of the techniques that I use. When you're looking at patterns, what patterns repeat over and over and over again? Well, you will find the more charts you look at, the more you're going to recognize that there are only 5 different patterns. It's either the cup pattern, or a bowl pattern. It could be, but let's call it a cup for now, or a V-shaped pattern. In other words, you're going from the left side lip, you come back down, you either make a curve or a straight line down, and you go back to that same level, and that retests the left side lip, and that could be a V or a cup. How it breaks out, I've developed some techniques that talk about a cup and ladle. In fact, what we're looking at here are inverse cup and ladle in the 120-minute chart of the E-mini. Now, even more important than that, you can get an arch formation or an inverted V. Now, a lot of these things take many, many words. It's unfortunate that if I say a peak, what do you think? You think of an inverted V, right? But look how many words I've got to use for one visual contextual thing. So that's the way it is. So we've got to use words. I also have a CD called Introducing the Chapman Wave methodology. Here it is. It is a CD book that is available on TFNN. It really goes through, it's got it goes all the way to, I think, chapter 27, 28. And what's really important about it, it gives examples of all these different patterns that I talk about. But the basic concept of my work, if I can just slide over to number 25, I think 23, let's see. 23, is that when you've got a blank chart, in this particular instance, I'm just showing bar charts. A bar chart is where you open, the close, the high, and the low. Candlestick is when it's filled in. You get the body, you get the wick, and you get the candle itself. In this particular case, all it is a bar chart. Happens to be of the semiconductor index way back when it was up in the 1300, 1400 area. That's not the point. That was back in 2000. And what is the point is that I found that I could have numbered each sequential higher peak. And a higher peak is just that. And if you go up to 20 and then pull back to 19.99, that's made a peak. And if you go to 20.01, that started a new leg up. That's how simple the concept is. Believe me, to get it to this simple vernacular, or the terminology to be able to use in such an easy way, took a long, long time, a lot of mistakes, a lot of dough to get to that. Education was expensive. Anyway, 1, 2, 3, 4. The object of the Chapman Wave methodology simply is to identify the lowest low bar and merely count for successively higher peaks after that. And that's where you've got to be a little bit careful. Sometimes at peak D, the fourth peak, you get a deeper pullback. In this case, that's what you got before you pull back. And then you peak 1, peak 2, peak 3, peak 4. And instead of pulling back, it immediately went to 5 and 6. Then it pulls back sharply. Then starts a brand new buy mode, 1, 2, 3, 4, 5, and it actually goes to 6 and 7. That's a peak G. There are only A, B, C, D, E, F, G, 7 letters. You can't go H because there is no H. I'll explain it. It's, all these words that sound so complicated. Let me show you what you do. There it is, A, B, C, D, and there it is with the up arrow and the down arrow. And we'll go through this. You'll get so used to it. Not that you'll always be able to identify it, but the concept is really simple. And on the way down, we count the troughs. Down, we get lowercase letters, and we call them troughs. Upside, we got capitals. Why? Because it just makes it real easy when you go, when you know that you're at D. It means be careful. Why? Look. Here we are. Before it went to D, then it went to an E and pulled back sharply. The E-mini from 1947.25. On the 9th of June, it pulls back to 1917.50. Then it climbs A, B, C, D, and it makes a D at 1978.25. I was just talking about 1978. Well, it was 87. And then 1978.25 at peak D. And now we've had, and look what I'd already drawn in for my subscribers to my service here at TFNN is called the opening call. It's a very comprehensive look at the markets every single day. And what I do is, I look at the different charts that we might either want to get in, we might be short, we might be long, etc. And I notate it and I show all the different parameters. I also show the parameters for the Dow, the S&P, the Qs, etc. GLD, the TLT, that's bonds. I talk about the dollar. It's just SPY, diamonds, very, very comprehensive look. And we might have them or might not, but the fact is we get this done every day. So now we've got the PT, and I had drawn in two patterns. One is there was A to B equals C to D potential. It just missed that because that would have gone to 1980.88 instead we went to 1978.25. It wouldn't be 88 because it's the futures only trading 25 cents. And then I drew in the down channel yesterday, and I said just let's be real careful. And one of the reasons why we went short this morning is because we had an alternate wave count. In my work, there's a way of looking at the waveforms, and the alternate wave count is really important, and how you interpret it is very important. So now what we've got is we've got basically a left side to the right side, a plumb line of 1978.25, and then it goes to the right side and it breaks down in the E-minis. What's really important is 1953. 0.50, which is the 200-period exponential moving average, that goldish line right there. Let me go through the numbers, and then we're going to go through these charts one by one. The Dow's down 118 at 16,905. The S&P is down 14 at 1963.47. The comp index is down 63 at 43.87. I will show the charts in a moment. And gold is down 70 cents at 13.18. Now, it's very interesting. I usually go on, but when I get to gold, I invariably end up stopping. Why? Because the gold chart is just very, very interesting. Let me just move this away for a second. Let me put it over there. I wanted to show something about the GLD. The GLD is holding the 200-period moving average. My thinking was this is a very big test for gold, because if the general market starts to pull back sharply and bonds rally and the TLT is up $1.07 at 112.56. Let me talk a little slow. Some of you might not recognize my South African accent, might be a little difficult. So I wanted to tell my subscribers that we might have to be ready, because if gold starts to rally, because it becomes a currency of fear as the market generally pulls back today, especially if it's all day, we got to watch this real closely. I'm still watching the GLD. It isn't acting quite the way that I expected there was a possibility of, but it is at 126.65. If the GLD takes out 126 support, then that's something different altogether. And that pattern that I've been drawing and showing you for quite some time, here it is. Look at the middle chart. That's the weekly chart. I've drawn this in months and months ago. Maybe a year ago, I drew in this pattern, and look, that's exactly the pattern that we've been seeing. The arch, the lowercase h, goes to a lowercase m pattern, and that m can become a continuous m pattern. So now what we're looking at is, I just wanted to complete these. If we go to the high-grade copper, which was acting beautifully, high-grade copper at this particular point, I'm just going to the continuous contract for ease. I had a fabulous couple of days. Now it's gone to a leg C in the daily, and I'm waiting to see, does it make the D or does it pull back sharply? You have peak C minus failure would be very, very negative. So what's very important is that copper needs to hold in the 320 area over this week. Otherwise, they'll be testing 314. And I need to do two other things. I want to look at bonds US H14. See, bonds have had a USU 14. USU 14 is showing, the September weekly chart is showing, the daily chart is showing very strong action, but until it breaks above 137 and 12/30 seconds, this is just a retracement. So we're going to be watching this really closely. And even more important, if I go to the if I go to the weekly chart, you'll see that the weekly chart broke support. Then now it's come back and it's gone inside. That black line is the 9-period exponential moving average. This series of notations here, this refers to the MACD, the moving average convergence divergence, 12.26.9 of the parameters that are being used. And this is the slow stochastic, and the blue line is the on-balance volume. So this is great price activity, and the MACD is flattening out. It hasn't yet crossed negative. So if it deflects back up, that'll say bonds can retest the recent highs. We'll come back. We'll talk to Rich in Orlando straight after this break. My name is Basil Chapman. This is the Tiger Technicians Hour. It's my pleasure to be on Monday through Friday, market days between 11 o'clock and 12 o'clock Eastern Time, 877-927-6648.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Basil Chapman, Tiger Technicians Hour, 877-927-6648. That's the number to call. And it's my pleasure to go straight to Rich in Orlando. Rich, how are you?
I'm doing well, Basil, and yourself?
Very well, thank you.
Good, good. What do you think of GPL?
So GPL is, let me just put a little rectangle around this because we know that rectangle formations can try your patience for a very long time. So GPL is Great Panther Silver Limited. So it is trading at $1.28, up 7 cents. That's actually 5.79%. Of course, the lower it is, the bigger the percentage the move. 120-minute chart shows beautifully the technique that I was talking about just a short while ago about finding each the most identifiable low bar and then merely counting the successively higher peaks. And what we're looking at is from the low bar in the 120-minute chart on the 29th of May at 11:30, it goes peak A, B, C, D, pulls back. Oh, sorry, my mistake. Yeah, that's right. It pulls back, and then it starts a brand new move and goes A, B, C, D, and it gets to another D at 1.33 on the 19th of June, and then it goes sideways between 115, is that 114 or 115? 114 and 133 from that day, and that, in fact, is a very long time in a 120-minute chart, from the 20th till today. And what did it do today? What did it test in leg D? It went to
132.
It goes to leg D at 130. I got 133 as a high.
Today?
So it's
133?
133.
Tonight, showing 132 is the high today. But okay, I'll take 133.
Take 133. It's yours. So that's the 120-minute chart, and it says, hey, we're still stuck in this rectangle formation. Even now, it's pulled back to 128. Those 5 cents made a difference because it is historically, I'm going to type this in so that for new folks that are not used to these charts, 133 was the high. And that's the high of today. So that says, number one, it's showing internal strength. Number two, it's showing in the technique that I use of the MACD and the slow stochastic. Let me just pull this a little bit further and expand it. And what we're looking at here is that as the stochastic went across positive, that little green line above the red line, the on-balance volume soared in this 120-minute bar, and it spiked all the way to that 133 level, as the MACD crossed positive, and now we're going to see if this is a brand new buy signal to buy mode in a 120-minute chart. If 135, it needs to break it by about 2 cents, becomes the new trading, not ceiling, but it's been exposed to a new set of dynamics, and that is all that resistance that was made from the highs of the 19th and 20th of June at the 133 area. It says, I don't care about it anymore. I'm going to treat that as a support area between 133 and 128, but I'm actually moving to new high ground, new territory. That's number one. Number two is the daily chart says, you know what? This is really just a spike, a very nice spike. Now, I know that Tom likes to look at volume. I've listened to him for years, and he always likes to talk about stocks that make a particular peak with high volume very often come back and retest that. So that can be years, it could be days, it could be weeks, it could be 120-minute chart, whatever it is. And in this particular instance, you see proof of that because today it went back and retested an extremely high volume high that was made on the 19th, did I say? That was the one on the 20th with 3.14 million shares. So two things are happening. It's starting to make higher lows, but it hasn't confirmed with a higher high. It just needs to get to 1.34 for leg C in the daily, and then I will have to say, great. Now it's proved in all aspects that it is capable of going to a leg D because it's gone to the leg C, making higher highs and higher lows. So we're waiting for that 1 penny difference. That's going to tell us. Now the weekly chart, that's the one that I've been looking at for some time. I keep looking at the stock and saying, do I want to buy? In the meantime, every time it moves very quickly. Otherwise, it does nothing, and that's when you get a little tired. It gets tiresome. But I like the fact that it surprises for quite some time now. Has been to the upside ever since it made a low of 0.87, was it? 0.88, the low back in the week of May the 30th. So now let me ask you, are you in the stock at all?
Yeah, I have a position in it at 127.
Oh, okay. So right now you break even to
About
slightly
even.
higher. Okay. So this is what I'm going to recommend to you because if you had asked me fresh, would I buy it now? Or would I wait, or would I short it if it was a shorting stock? No, what dollar? 128 to say $120 stock. I would look at it with the aspect of what would I do right now. So we've got that clear. What I want to do, and we've got a break coming up, is to look at it in the weekly because 140 is the magnet that I think it's going to go for.
Thank you.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi, everyone. Basil Chapman here. This is the Tiger Technicians Hour. Just looking at something. The GLD is down 45 cents at 126.56. Very interesting. TLT is up $1.11. So we're going to be following this real closely and also following those gold stocks. Some have held very well, and we've got one right now. We're looking at GPL, and we've got Rich in Orlando. So, Rich, this is what I'd be recommending if someone asked me right now, what would I do? I would say because if 1.34 to 1.35 is hit, and it's hit preferably in the next day or so without taking out 122 on GPL, Great Panther Silver, I would immediately be looking at the weekly chart and saying, aha, the previous high back at 138, the week of February the 21st of this year, that to me looks like it should be very easy to touch if we can get to the 134.35 area. And once you do that, then the 200-period moving average of 140 becomes a magnet. That would improve the weekly, the monthly chart. And instead of having all these inverted V formations that are failing, suddenly you've got a cup formation. It's like a W, soft W pattern, makes a big kind of a bowl formation, and all of a sudden you're pointing to the 1.40 to 1.50 area. So those are the upside potentials. The downside just says simply that if there's a break below at this point I'm going to say if there's a break below the 122 to 120 support, watch out, because 115 would be next support to monitor, and that would go from the daily chart to the weekly chart, and then a close below 115 says, we're just in a trading range, and we're going to be bouncing into this area between the 1-ish and 133 area, and it could continue for a while longer, making a much longer extension of a wider rectangle formation. So far, I like what I'm seeing. I would not like it if today's a failure pattern that closes at the lows. Whoops, it's now 125. But if you ask me what would I do, I'd say I'd be waiting for the 124 to 120 area to be tested, and then I would be nibbling because it has a good chance to try to go back to the 133 area. If you're long, I would just say to you, if you've been long and you've sat through the decline into the 0.88, so the under $1, I would say to you, I probably would not want to go through that again, and I would put a stop on some part of my position at about 115 to 117, just something to say, hey, I don't want to go through that again. But I like what's going on. We've just started the second day of the week, so I can't really talk about the weekly chart other than to say those are the parameters I'm looking at, and the fact that it's held the 9-period moving average for four weeks, 4 weeks now in the weekly chart and 1.5 months in the monthly chart tells me that the 115 area should be very good support based on the history that it's trying to produce at this particular point. So I hope that helps you. So that's Richard and Orlando looking at GPL, and it is pulling back a little bit here at 126. And the 120-minute chart, having gone to that D, says, always at a D, be careful, you can pull back a little bit from the D. It could be a little bit or it could be a lot, but D is where you want to be a little bit careful. And that's so that corresponds to exactly what I've been talking about the 133 level being so important, because it needs to break to 134 to start another leg up in the daily and the weekly. So I hope that helps. Now, I had a couple of questions in the den. If you don't mind, folks, I'm going backwards from the den questions. CRM is getting creamed. It's down 295, down 5% at 54.36. This is Salesforce.com. I'm suspecting, and as I said months ago, I think we've made a peak F top in the monthly chart of Salesforce.com, and that says time and price from the 67 round number high. I always look at round numbers. It pulled back to 48.18. Now it's in the lower part of the half of that range. I'm really watching this real closely. It was on my list between CMG, CRM, and a whole bunch of the hot stocks. It was on my list for the last 2 days as possible shorts, and this one would have been a great short from the 50. Oh, let me just mention this. It made a 59.49 high at a peak F top in the Chapman wave back on the Thursday last week, or Wednesday, on the 1st of last Monday, on the Tuesday, on the 1st of July. And then the next day, it had a high of 59.48. I call that a two-bar reversal. It's a technique that I developed over many years, and it's one of the many techniques that I have. And in this case, it says 53.93 is the 200-period exponential moving average, which is probably going to test. If it closes under that, that'll start to deteriorate the weekly chart as ABC, as it becomes a peak C minus. Peak C minus is a very negative. They say you're probably going down to the very bottom of the bar. So I'm watching CRM. Upside is limited to 55.65. It's at 54.37. Next question is, we've got Rob in Paramus, New Jersey. Rob, how are you?
I'm good. How are you, Basil?
I'm well, thank you.
So I have a question for you. So I was waiting to short the market, and now it's gone. I'm not in anything now.
Okay.
And would you go in today, or do you think you need to wait now since it's gone down a lot 2 days?
So then let's do this, and I'm sure that for those new folks that are using eSignal coming to us via the eSignal site, let me show a couple of things. I'll mention it again if you just tuned in. This is my name's Basil Chapman. My service here, I have the Tiger Technicians Hour, 11 o'clock till noon every single market day, Monday through Friday. And my service is called the opening call. One of the reasons why we went short this morning, and we're trying to get some other shorts as well, as we have a particular stock and options, put options on that stock, which is doing really well, is because in my methodology, there's something called an alternate count. It says that you might get to a D, a peak D, the fourth peak, but at a certain point, because the letters, the price and the technicals are in such a position that each higher high might in fact become a top at that point, I have an alternate wave count. And if I was looking at the Dow, so I'm going to answer your question first, right away, and I'm going to say to you, Rob, I would start, even though you've missed a little bit. We're only at, 200 points off, 150 points, whatever it is, off the all-time high, 6, 7 points, 10 points, or 15, whatever it is, off the S&P high. I would nibble, just a little protection I would have in the short position on any one of the indexes, or maybe the volatility index or something like that. I'd have it. At first, I would just treat it as insurance, and I'm going to explain a little bit more as I move through this. If you're looking at my charts, the Dow has at this particular point an alternate wave count. And I mentioned to my subscribers this morning, I'm calling it peak C for now, but there's a chance it could become a peak F, and if the Dow closed under the 9-period exponential moving average of 16,009, I think it was at 940 this morning, now it's at 16,938. If it closes under that, that would pretty much say that there's little chance of a peak C, and it's probably a peak F. One of the reasons why we want to initiate a position as well as the fact that my 120-minute chart had gone to a peak D, and this is also what I show subscribers every morning. There's that peak D in the 120-minute chart. This is this sector right here is the Dow 120. This is the VIX, the volatility index 120-minute chart, just making a leg B, maybe a peak B, but a leg B at 1247. That's 2 points. That's 20. That's 5. That's 20% or something off the low that it just made it 10.28 just the other day. So when you're going to move this quick, and you're going to move this tackling at 1247, it's only 5 cents away from breaking above the last high that was made when the Dow made its low at 16,746. That's telling you that the selling pressure is intense. I'm not calling it fear. I don't know about the fear right now, but I am calling it selling pressure. I also have a couple of other indicators. Here's the trend index, and my arms index is a Chapman wave. Richard Arms made a fabulous, he's got a whole bunch of techniques. This particular technique is the TRINS, the short-term trading index. I use it in a completely different way, and my method said that even though we should see weakness at some point over the next day to 2 days, there might be a sudden burst of energy to the upside, surprise, before it goes back down again. So we're going to be watching that, and the trend went even higher today, went to 2.42. Right now it's at 2.201. But here's the kicker. In my daily chart, as I say, that peak C is really an alternate wave count, F/C at 17,074 in the Dow. And the 1985s, that's 22 points away from where we are now in the S&P. The S&P is much weaker than the Dow. The S&P is down points... so the S&P is down 14. I don't see right now how it could be anything else but a peak E in the S&P. So here we are. When you ask me about what am I thinking, I needed the proof of something like this morning, but the day is young, and with that trend gauge flashing, I've got to be a little careful if there isn't a reversal by the end of the day. So the Dow only closes down 25 points, S&P maybe closes down 3.5, and then tomorrow's an up day. So I would put a kind of a starter position, because I'll explain why. Mm-hmm. If I go to the Dow, I've got the alternate count, and everything about it right now, that might be not in an hour's time, but right now down 132 down, says this is likely a peak F with what I call a right arm extension failure, and we'll see, because the stochastic still at 86%, and that's quite good. But if I put it together with the QQQ series, here as well I had an alternate count, and that was C/E. I hate it when I have to have an alternate count. That's like saying we could go up, we could go down. But actually there's a much deeper analysis, and the deeper analysis said it's a peak E in the 120-minute chart, so either way we should be pulling back. This is a deeper correction in the Qs at minus 135, down $1.40%, 140%, at 94.06. Than one would expect if it was really a C and we were going to go to a D in the next couple of days. So I'm inclined to think, and here's the IWM, the Russell 2000 ETF, alternate count G/C. sitting right on the 200-period exponential moving average, except it did go through a peak E in the Chapman wave in the daily. So this says to me it's under the 9-period moving average for the second day. That's not a good sign. The MACD turned down. Stochastics way under 80% to 61%. You've got the same thing if I go to the NYA.X, the New York Stock Exchange, the very broad, almost 2,000 stock New York Stock Exchange. Now, peak D with the stochastic still at 84% is good, but it is turning down. Relative strength is not good, and the MACD did not confirm with a higher peak when it went to D than it had when it went to B back on the 24th of June. So when I put the whole, and the other thing that's really important is that the TLT is in fact climbing as money is going to, I say this with a little chuckle, the safety of bonds, but it is going to the safety of bonds. So until the TLT is able to make a second U formation, making what I call a soft W and breaking above into the 114s, I have to consider, yep, this could be an alternative count, and bonds could fail at any point. But I'm treating this right now with a lot of respect and saying that was a great 2 days we just had in the TLT. It's improving the weekly chart, not great, but improving it. The weekly chart says you already have to break above one. You have to get to 114 for the weekly chart to improve, and the monthly chart is still testing the resistance level. So I'm trying to put it together in anticipation that the market actually does close down triple digit in the Dow, strongly in the S&P, rather than having a good comeback by the end of the day. And that would imply that even if the trend gauge does work and there is a bounce, that bounce should fail after about 2 or 3 hours and start to come back down again. The market will come back down. So I'm going to make the recommendation that you think about which one it is that you want to use as a shorting vehicle. And I would just start the position here. And I think you'll have, if this is going to be a stronger rather than just a short-term pull back to the 16,600, 400 safety area, another 400 points or so, that'll be one thing. But if this is going to be a longer, deeper timeout, and if you look at the IYT, the iShares of the Transportation Index, I've got an let me just show you something here. I've got an alternate count that says this could be a D. It made the 1-to-1 extension, and the MACD deflected lower, and the transports are really important, and they're down sharply today. So I'm trying to put the whole thing together, and I'd say I'd err on the side of being a little cautious by taking some insurance policy. This morning was the perfect time to set up the trades, but I think you're going to have plenty of opportunity if this is going to be longer and deeper, and I will not know until I wanted to show you the IBB, which I featured for my subscribers. I had an alternate count.
Do you think the market might go down for 4 to 6 months, or? Now
that is the very best question.
Then it'll be good to get in.
It's really that's a great question, and the only way I can answer it is to take a drink of water first of all. Hold on. Now that I've got my vocals saturated and liquidated, and good, there's a break coming up. Let me do this. I'm going to take a break, and I'm going to explain to you how I'm going to answer that, because I'm going to show, as we're going out here, I'm going to show folks who are looking at the den a particular chart, and this is from London. Look at the cranes. Look at the buildings being built. I'll talk about that and try to put it into context as soon as we get back.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Folks, we're back, and the Dow, as I say, is down 140, S&P's down 16. So we've got Rob in Paramus, New Jersey online, and he asked a great question, and he's looking out. So now what I'm going to do is I'm going to talk about the Dow in the monthly chart and tell you what I'm looking at. If the Dow is in leg E, and I always say when you get to D or E, you've got to be a little bit careful. You've got to monitor your technicals very closely. I'm looking at the stochastic and the MACD as being very strong. The MACD, the moving average convergence divergence, is still positive. The stochastic's at 96%. That is like if it was at the bottom, it would be down, showing no testosterone, no energy whatsoever at 3.5%. Here it's the exact opposite on the upside. So the way that it's going to come down is that the daily leads the weekly leads the monthly. I talk about time frames in my CD, introducing the Chapman Wave methodology in great detail. So in this particular instance, I'm going to expand this so you can see what I'm looking at. It has just gotten to the dashed line resistance, what I call the inside track resistance line, and it's trying to break out to be able to go to the next up channel level, and that's where it's going to have a tough time. If I look at the S&P SPX monthly chart, also the candle is not complete because we're not even halfway into the month. We just began the month, and this is going to be a very important moment because I have a couple of indicators both in the Dow and the S&P to say, watch out, because you're getting to a level where certain indicators have not been before, and this is also the area where they have pretty sharp pullbacks, right? So until the S&P monthly chart breaks 1870, that's sort of 100 points below where it is here, that's 1,000 Dow points, I have to say that it's still acting pretty well. The weekly is the one that I'm be monitoring this Friday very closely. Why? Because of that two-bar reversal that I talk about. 1985.59 was the high last week, and this week the high is 1984.22, $1.30 lower in a long-term monthly, weekly chart. That's a very slight differential between the two highs. So this is something I'm going to monitor. If the S&P weekly cracks 1940, goes to 1938, and it does it, let's just say it does it in July, that would say to me, be careful. We could have a really sharp pullback from July going into August. It could even be another leg down. So I'm going to answer you this way, Rob. I'm going one step at a time. I've got a number of stocks, number of indexes are reaching critical mass right now on the upside. I think they're about to fail. I don't know if they're going to. I'm starting to get into the positions that say if they do fail, they will impact the weekly charts. That's why I say in core mutual fund positions, I'd still be holding right now. I would probably say, you know what, you could lighten up a little bit, take 8%, 7% off that you can put back later on. Nothing wrong with that. But I'm just going to say I don't have indicators for my monthly and weekly charts that tell me be really careful right now. But I do have in many aspects, and I mentioned it to my subscribers for the last week or so, I'm getting signals in my dailies that are saying, hey, we're very, very extended. So I hope I can answer, and I'm going to do a little bit more over the next two sessions, but this is how I'd like to start it off, saying be real careful, because if the Dow cracks, if the Dow breaks under 16,800, that's going to say we've got more to go. So thank you for calling, Rob. We'll talk again.
Thank you. Bye.
Thank you. I hope that helped you. So, folks, we've got Tom O'Brien coming up. He's going to host the Options Hour live, and he's going to be a guest host. So stay tuned. Should be a great show, as always, on a Tuesday, Options Hour with Tom O'Brien. And don't forget, e-signal listeners or viewers, my work is based on my Chapman Wave methodology. Check it out in my opening call. Right there on the front page, you get 2 weeks free. Thanks for being here. Be cautious, and I will be back tomorrow. Thanks for being here.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
This is TFNN.